Welcome traders. Today we're going to be taking a look at the Wyckoff methodology, how to trade it, why you should implement it into your trading, and where it came from. So let's start it off with Richard Wyckoff. This is the man who invented the Wyckoff methodology. Richard Wyckoff he died in 1934. Okay, so he died almost 100 years ago. He created the Wyckoff methodology in his times. So it's been almost 100 years of basically forward testing. The Wyckoff methodology is basically the creatine of the trading industry. It is the most tested. It's proven itself time and time again for 100 years. That is why you need to learn it. Okay, so he was a stocks trader. In short, he basically realized that smart money was manipulating the stock industry. They had to manipulate the markets to be able to get their orders in. On here, I'm going to be linking this in the description, so feel free to go onto here, read all of this. It is actually kind of all important, but most importantly today, what we're going to be going through is actually just the technicals of it. All of this basically, how it looks on a chart, because it's not always picture perfect. It looks very nice and picture perfect here, but in the markets it can be very deceiving. So let's take a look at Euro USD. And this is a live market. We're looking at the 23rd of August, so yesterday. We had a very nice accumulation schematic. We're going to go through this in detail. So the first thing we're looking for is the preliminary supply. And it's not that important. It just means that we've got the first sign of some buyers entering the market, sellers leaving the market. And then after that, we're looking for a seller's climax. And that's usually going to be quite a big move, oversold. If it was a distribution, it would be overbought. So this here is a very clean seller's climax. We can see it's literally a straight drop. It's a climatic downwards move, followed by, we then have the automatic rally. Now the automatic rally, the seller's climax to the automatic rally is going to give us our range of the Wyckoff. So we can take the seller's climax, which is the bottom, to the automatic rally, the top, and just drag that across. This is our range of our Wyckoff. So the automatic rally is basically after price moves in a seller's climax. You can imagine down here, there's going to be not many sellers left to enter the market. We've already, all the sellers were up here, in here, and now it's looking like, it's not a great sell position to be entering here. Where's your stop loss going to be? It doesn't make sense. So it's very easy for the market to then move. That's why it's called the automatic rally. It automatically just moves back up in a counter trend direction. That creates the roof. Then we're looking for our secondary test. And in this example, we have a clean secondary test, and because it doesn't break the seller's climax. Now it can break the seller's climax, and that's completely fine. But in this example, it doesn't. And what that means is we're creating a lot of sell side liquidity. We can clearly tell that it's the lows being manipulated and not the highs. So now what we're looking for is a move out of the box. We're always going to be looking for our spring to move out of the box and break the seller's climax. This is where the spring begins, pushes down into here. And now we can look at the volume indicator to get an idea of what's happening. So you can see on this candle here, after we have this downwards push, as soon as we break out, we start getting very small doji candles, and the volume actually starts increasing. You can see it very clearly increasing. And then we get a huge volume candle up move, and that's what tells us that this is very likely to be an accumulation. So let's just label the spring. Cool. Now after the spring, what we're looking for is the test. So sometimes you're going to get the sign of strength before the test. Sometimes you're going to get the test before the sign of strength. In this example, this high doesn't break this high. So we do not have our change of character yet. I'm not looking to take any trade positions, but we do clearly have our test. So the test is basically the testing of the demand of the spring. So in this spring here, you can imagine we've very clearly got an order block of where sellers came into the market, pushed down, manipulated some of the inner stop losses in here. This creates the area that gives us our test. Now that we have the test, we're looking for a sign of strength. Boom, really big sign of strength. Completely breaks out. At this point only do we begin to look for long positions. So it's this change of character here that tells us we can now look to take a trade position. I was completely uninterested in taking any trade positions until that sign of strength. So make sure you jot this down. You are not going to be entering any trade until we have at least spring and sign of strength. On the flip side, if it's a distribution, so we have the UTAD and the sign of weakness. Okay, so now we've had our spring, we've had our test, we've had our change of character. So we know that the market flow has changed and we're now taking the stop losses of the sellers. Okay, so the banks have entered their long positions. I mean, look at this. It's very clean. There was so much time for them to get all of their orders in. Once the orders are in, boom, sign of strength. And now we can actually look to take our position. So I like to use a mix of things. Fibonacci, always great to have. So we're going to take a fib from the spring to the sign of strength. And then obviously we're going to be using the golden region. But alongside that, we're going to be taking the bottom order block, which is the last clear manipulative sell within the move before the move to the upside. So this is going to create our last point of support. Now what we have here, the Fibonacci, the golden region, which is, and obviously this isn't a lesson on Fibonacci, so I'm not going to go in detail, but the 618 to the 786 lines up perfectly with our last point of support. So we've got multiple confluences. We're almost certain that this is clearly an accumulation. So we're going to be taking a long position on the very top of the last point of support. Stop loss is always going to go below the spring. Now this is important. It's up to you whether you want to put it below the spring, whether you want to put it below the last point of support, whether you want to put it below the test. Now, if we put it below the test, for example, sure, it creates a bigger risk to reward. It's 3.5 rather than, 2.2. However, in this example, you put your stop loss on the test and you get stopped out. Now, I personally prefer to trade based on high probabilities. I'm not looking to take 10% from one trade. I'm not looking to turn £100 into £1 million. I am looking to mathematically have an edge on the markets. This is my mathematical edge. Okay, we've got a high probability setup. We've got a stop loss below the accumulation. So if they hit our stop losses, then they're hitting all of their stop losses. Now the bank is not going to be hitting their stop losses. So if we're on the right side, if we are with the composite man, we're sorted. Okay, we've got a nice probability. It's very likely that we're going to get a take profit. Now, the take profit, some people might be aiming for the 27% on the fib. Me personally, again, I'm playing probabilities, not crazy risk to rewards. I'm going to be looking to catch the liquidity of the high. When you understand how liquidity works, it's very likely that price is going to go back up and take the liquidity from the highs. So 2.26 risk to reward, pretty simple. And boom, take profit would have been hit within a few days. The best part about this as well is you didn't need to be sat here watching the markets from this point to this point trying to catch an entry. As soon as we've got our sign of strength, once we can then identify our last point of support, we simply place an order and then we sit back, we go to the gym, we do whatever we want to do and let the market work for you. That's what trading is about, not being sat here scratching your head, scared, not sure what to do. You have a methodology, you follow it, and it works for you, not the other way around. Now, I want to highlight something else. Let's say if you wanted to take it even deeper than this, and we understand that the markets are fractal, okay? There is structure within structure within structure within structure. So, on the last point of support, we might want to drop the time frame and understand, is there any other sort of accumulation that's going to happen? Because if this here is an accumulation, then within here, are we not going to have an accumulation before we now get a big up move? Probably. So let's drop the time frame to the 5 minute. And we're going to look at, once price taps the last point of support, can we look for an accumulation to take our long position? Now this is the first time price taps it here. Again, you could maybe have thought, to be fair, this does look reasonably accumulative. You could argue seller's climax, automatic rally, secondary test. sign of strength phase B, spring, and however, we do not get the change of character. So even if we were looking at that, boom, we never got the change of character, price pushed to the downside, we know that's not the accumulation. Now we get this new possible accumulation. We have a seller's climax, very clearly a seller's climax, automatic rally, secondary test, sign of strength in phase B, secondary test break. Then we get a little fight between supply and demand before we get our spring, which very clearly breaks all lows, and now we have our sign of strength. Now, if you're looking to take this trade position on the 5 minute, because you've already identified the higher time frame Wyckoff, we don't need to be catching perfect orders. We simply just need to enter after the market has accumulated. So what I would do in this example, rather than trying to set an order looking for last point of support within the last point, let's not confuse it. So we're going to set a long position above these inner highs. If this high here was the one that created a spring, as soon as that high gets broken, I want to be in the market. So we'd set an order there. Stop loss can actually be shorter than before because it's going to be under this low, because now we've had a new accumulation. Just like the other one, we're not going to expect that low to be broken. So this is how you could get a bit of a better risk to reward. Again, we're just going to be targeting the previous high as liquidity. There you go, 90 pips. So now we've turned it from 2.2 into 4.2, and we didn't reduce our probability, maybe slightly, but we've barely reduced our probability and we've increased the risk to reward. So once you understand the fractal nature of the markets, we can be using Wyckoff within Wyckoff to really kind of manipulate our odds. So that's the Wyckoff accumulation. Now, whether you entered based on the first strategy, which was simply just setting the order here, or whether you entered on the second one, which was after the inner accumulation, regardless, you hit a nice take profit. Okay, that's all trading's about. We're just looking to have an edge over the market. That was Wyckoff accumulation. I hope you've understood it. Now let's move on to Wyckoff distribution. Just before we get into Wyckoff distribution, I just want to let you know that I actually run a free analysis channel where I post, charts pretty much every day or at least every week, send the odd trades, and just update, big moves, Bitcoin, everything like that. The link is in the description, so if you want to join this for free, you can. We also have a premium section, which is where I send every single trade that I take every day. And also, I have an advanced forex course, which has just been released. It's only £99. It has everything in here. Look, Wyckoff accumulation, Wyckoff distribution, fractal Wyckoff, so Wyckoff within Wyckoff. This teaches everything you need to know in order to basically master technical analysis. So if you want this, I'm going to leave the link in the description. Get in touch, and let's get into the distribution. For this example, I'm going to be looking at euro to New Zealand dollar. Before we get into the distribution, I just want to make sure that you understand that the higher time frame is always the most important. So even though I'm taking these distributions and accumulations on 5-minute time frame, 15-minute time frame, and the likes, it's only after I already have a bias based on a higher time frame. So let's look at euro to New Zealand dollar then. Let's just understand smart money. We've got liquidity right here, and we also have very, very clear inefficiency in the market below these lows. Okay, so price has pushed up, we've pulled back a little bit, had a correction, a reaccumulation, and pushed up to take the liquidity of these highs. However, I'm well aware that price basically must return to this area. So just taking that into account then, I'm going to be only interested in looking for short positions after the liquidity of these highs has been taken, because at that point we're going to be able to get enough orders into the market to bring the price down. Okay, so it starts off with the higher time frame. We've got our bias. We're looking to take the liquidity of these lows after the liquidity of the highs has been taken. So now let's drop it to the 5-minute time frame, see if we can find some sort of distribution within this. So here is where the liquidity is grabbed, and this is where we begin to look for a distribution schematic. Okay, so first off, again, we've got our preliminary supply. Very clean. This is where the first lot of buyers are getting out of the market and the first sell orders are probably getting placed. Then we have a very clear, again, buyer's climax. And with the buyer's climax same as the seller's climax. We're just looking to see clear direction. So even though there's little pullbacks within here, it's very clear that it's a buyer's climax. You know, it's only trying to go in one direction, which then creates the automatic rally. So now we can draw on our range. I don't actually do this anymore, but just for this video's sake, I'm going to be doing it. This is our Wyckoff range. So after the automatic rally, we're looking for the secondary test, which is testing the supply of the buyer's climax. Okay, we can understand that. We can see that very clearly. And again, it doesn't actually take out the buyer's climax. So what does that do? It creates buy-side liquidity to be taken. After this secondary test, we have the upthrust followed by the UTAD. Now, sometimes you're not going to get both an upthrust and a UTAD. So you don't always have to have both. Just as in the last example, we didn't have an STB. So here we have the upthrust, and then followed by the UTAD, which is basically the opposite of the spring. It's the highest point. Again, it clearly breaks out of the range. Even though it doesn't go massively out the range, it still clearly gets out of the range, so that's fine, that's good enough. Now on this example, it's pretty different to the last one, because we could have looked for short positions before the automatic rally was broken. So before we get that main chock, we could already have looked for positions because of how price came up. Now we can draw a very clear bull channel up here. You see this bull channel? This is nice. This is exactly what we want. It's a very clean distribution schematic. So the first inner chock is actually right here. Okay, so there's the UTAD. We could call this the sign of weakness. Even though it doesn't break the AR, it still breaks the inner structure. So I'm going to have this as the sign of weakness. Now, after the sign of weakness, we've had the UTAD, we've had the inner chock, we've had the sign of weakness, which means we are now looking to enter short. So again, we're going to take a Fibonacci from the UTAD to the sign of weakness. And we're also going to be looking for what is the last clear order block. Now, we could argue that it's this top one right here. Last point of supply. However, I'm not even going to do that, because realistically, if it's me, I'm going to be looking to enter on here because I want to get in the golden region as well. And as I've said, I'm looking for probability, not crazy risk to rewards. So this is my last point of supply. I'm just going to drag that across, and it lines up perfectly again with the golden region. So what we're going to do, we're going to simply set an order on the 618. Stop loss goes above the UTAD, of course, 17 pips. And the take profit. Now the take profit is going to be, as explained, the liquidity of these lows. Okay, there we go. So in this example, you've actually got a 9.3 risk to reward. So you're still actually having a 10-to-1 risk to reward. Now obviously we're not going to be taking 9.3% on the trade, because we're going to be taking partial profits right here, and then again here on the liquidity of these lows. So you're never actually going to get the full amount. We probably would have got about 4 or 5R on this position. If you wanted to wait for the main chock, if you didn't want to enter the trade until after the AR is broken, which is completely fine, you know, some people like to play it more safe, that's still going to give us a good opportunity. So here is the actual main break of structure. This is when we know for a fact price is looking to go down. Just move that. So here's the break of structure. Now we can still find another entry, even if we took this position up here. Once price pushes down and breaks out, we've took partial profits on the 27% of the fib, so we can actually take a re-entry as well. I teach this in the course, so don't worry if you don't understand this. I'm going reasonably fast. You can always come back and watch it again. So we're going to take our fib from the high to the low on this 5-minute time frame, and we're not looking for last point of supply up here. We're not looking for crazy risk to rewards. Because prices broke out, it means that the probability is now really, really good for price to continue pushing down, which means we don't need crazy risk to reward. So for this reason, I'm happy to enter on the 50% of the fib. Now, I'll never enter below the 50% of the fib, but I will happily take a trade on the 50% of the fib, because that is when price comes back up to a discounted area. So let's say we didn't catch this first trade, we didn't catch this position for some reason, was waiting for the actual break of structure, so we only caught this one. Again, we're taking the take profit down to the liquidity of the lows. So even on this position alone, you're looking at 6 risk to reward. A 6 risk to reward. That's pretty incredible. You know, if you can catch consistently trades like this, 9 or 6, or maybe you caught both entries, you know, maybe you caught more within it. This is why Wyckoff is so powerful, but it has to come with that top down. So that's the distribution. I hope you've understood that. I'm just going to highlight basically the main points to take from this video and to implement into your Wyckoff trading. So let's get some blank space. Okay, so point number 1, we only ever look to trade after the UTAD or spring followed by a chock. Now that might be an inner chock, it might be a main chock, a break of structure, doesn't really matter. As long as we've had our UTAD or our spring followed by a chock, now we look to take a trade. 2, probability over, sorry, I couldn't find it, probability over profitability. We only ever look to take the trade after the UTAD or the spring followed by a chock. Probability is more important than the profitability. We're not looking to catch 100 to 1R, we're just looking to simply make profit consistently, okay? And number 3, higher time frame comes first. That's it. Write those 3 things down. Always follow these rules and I'm pretty certain you're going to find some success in the Wyckoff. That's everything for this video, guys. I'm going to also be going through the reaccumulation and the redistribution at some point. That's a bit more advanced. I hope you've learned something. So please leave a like, subscribe to the channel for more, and drop a comment on what you enjoyed the most. Thank you.